Hello, my name is Brandy Phillips, and today I'm going to talk to you about accounting and the effects that it has on labor management relations. During bargaining procedures, should there be sharing of accounting information between labor workers and administration? Accounting within labor organizations refers to their financial practices and whether or not there should be sharing of financial information between management and employees. Some think that disclosing financial records will advance relations, make bargaining efforts easier, and advance corporate success, while others do not. By looking at accounting and labor relations, labor demand, and accounting information history, and by financial dishonesty, we will determine whether the field of accounting will improve labor management relations. So what is labor management relations? It is the engagement between managers and the labor organization to represent the company's and employees' best interests when bargaining. And there are three basic principles to the labor management relations process. First, there is the adoption and support of an economic system. Next, employees are allowed to decide what is in their own best interests. And then, when the majority of employees seek to do so, they either join or form a labor organization and engage in collective bargaining procedures. And the final consideration in the labor management relations process is financial procedures. So, what does the field of accounting offer to the study of labor management relations? To answer, let's first look at demand accounting history. In the 1920s, there were requests for financial records, and the unavailability of these records made it difficult to bargain. In the 1940s and 50s, financial information was published regularly to justify wage demands. And to help unions better understand financial statements, a How to Read Financial Statements guide was published. In the 1950s, ability to pay was an issue, and in the 70s and 80s, there was a call for greater accountability by corporate decision makers. And in the 1990s, some unions refused to communicate for fear of increasing power of the workers and establishing a voice. Financial records are important to labor negotiators when bargaining. If employers declare the inability to pay their employees, they must produce the financial documentation that shows this. The more information available to bargaining negotiators, the more equal the divisions are and the shorter the bargaining time. The Employee Retirement Income Security Act of 1974, also known as ERISA, required that plan benefits be revealed. Although ERISA established this disclosure rule, organizations still did not inform plan participants because of their lack of understanding. Although managers didn't follow the disclosure rule, ERISA still progressed organization dealings and lightened settlement talks. Disclosure of accounting information strengthens management accountability, and it is known as the backbone of accounting. Audited financial statements hold managers accountable. The financial statements are also disclosed to stockholders and serve as evaluation tools. Disclosure may uncover threats to labor interests and influence management behavior. When being held accountable, managers will possibly make more considered and equitable decisions than they otherwise might. When discussing accountability, we think about financial dishonesty or embezzlement. Embezzlement comes from trust violators. Trust violators are betrayers of those who entrust them with their monies and its documentation. Looking into labor financial documentation began in the 1950s when the government was called to become more aware of the accounting proceedings in labor organizations. In 1959, the Labor Management Reporting Disclosure Act, or LMRDA, was created after the poor management of labor workers' capital was discovered. The LMRDA required the reporting of financial transactions in labor organizations and their employers. These reports showed their financial conditions for the preceding year and revealed any financial dishonesty. So to further protect against embezzling, mandating specific financial controls and requiring audit trainings was put into place. Again, the questions are whether or not the financial disclosure of information is needed in labor organizations and what effects the field of accounting has on labor management relations. Answers to these questions begin with disclosure as employees and employers disagree. They disagree over the amount of data reported, the kinds of data shared, and when to share it. Employee data interpretation is also a problem, and there is a total distrust in the sharing process. With the given problems, What effect does the field of accounting have on labor management relations? Accounting affects labor management decisions as to how things are accounted for. The accounting emphasis is to create an effective policy for financial disclosure, accounting training for union employees, and to increase accounting involvement for policymakers. So finally, the primary objective should be to use the fields of accounting, auditing, and education to progress U.S. labor management relations and their effectiveness.